Hi, guys. So today we're going to talk about inventory. So there's a couple of things that we have to do in order to keep track of our inventory. So you guys are going to learn how to prepare the inventory stock record. We're going to look at how to determine what type of inventory we should take. Should it be what we call LIFO, or last in, first out? Should it be FIFO, first in, first out? We take a weighted average of our inventory to see how much our inventory costs us? And so we're going to be looking at all these different things because it's going to need to change for different businesses. So if you have consumables, things like milk, food, that kind of stuff, you might want to do that first in, first out method, because if you don't want you want to make sure, if you think about, the shelf in the freezer with the milk, right? Milk has an expiration date. It only lasts for about 2 weeks. So you want to make sure that milk that you get in on the first sells first. So if we have consumables like that, we might want to do that first in, first out. But if it doesn't matter, let's say we own a hardware store and the parts are the same, right? The 10 millimeter wrench is a 10 millimeter wrench, which is a 10 millimeter wrench. Doesn't matter when I get it, it's not changing. That kind of store, I might be okay doing a last in, first out. So, the newest product is going to be the thing I want to sell first. Okay. So that's going to be a last in, first out. And so we're going to talk about those different types of inventory. The first thing we're going to do, though, is prepare that stock record. So we want to make sure that um, we're keeping track of our inventory, because our inventory is a cost to us. And the higher our inventory cost, the less money we're going to make. And so we need to make sure that we understand how important inventory is to us as a business. Because, like I said, if we end up with too much inventory, it's going to cost us in the long run. It's going to cost us in terms of our income. So they look at some of the most efficient quantities of inventory. So how do we determine how much inventory we should have? So they look at, does that amount of inventory require warehouse space? So that means, are you going to have to build a warehouse, or are you going to have to rent a warehouse space? That kind of stuff. Uses capital that could be invested in other assets. So are we having to purchase more and more and more, but we're not selling at the same rate that we're purchasing? And then, of course, some of that is going to become obsolete and unsellable. So all you have to do is go to Walmart and look at the clearance shelves. All of that stuff has become unsellable. We don't sell flip flops in the middle of December, right? So we don't sell t-shirts and shorts in the middle of December. If you go to Walmart right now down the street, you will see that they're already phasing out all of their summer clothes and putting them in for fall. So there's already jackets, and I went up there the other day and I saw that they had ski outfits already. So those, they transition. So, stores like Walmart, they transition from season to season. And then we look at, do we have to keep um, a lot of inventory? And it literally just depends on our business, on how much inventory we have to keep. So there's two different types of inventory methods that are used the most. So the first type is periodic inventory, and that is taken at the end of the physical period. So once a year, the whole store gets counted. So I know when I worked at Kmart, we would hire the inventory people. They would come in and they would literally go through every single shelf, every single nook and cranny, and they would count everything we had in the store. We did that. That was our periodic inventory. Okay. Our perpetual inventory is an ongoing, continuous inventory. So, right now, Walmart does both. Every time you scan something to buy it at Walmart, when it scans when you go through the checkout, it decreases the inventory by that item. So it keeps track so the store knows exactly how many items they have. They might not necessarily know where they're at, but they know how many they should have. Okay. So every store does a perpetual inventory. So they always know how much they have. And then once a year, they do that periodic inventory to make sure that those two things um, are working together. So notice it says the perpetual inventory is also referred to as the book inventory because that should be the most accurate accounting of our inventory because it is done right then. So we're going to be using an inventory record, and this is what it looks like here. I'm going to use my little pointer, my little laser pointer right here. So it's inventory record. We have our date, and then we have what the item is. So in this case, it's beach totes. We have our stock number, so what the item number is. We have what we bought. This is a beach tote small. So notice it says number of units on hand, 22. Each of them cost us $15.95 for a total cost of $350.90. Then I bought some mediums. Notice the stock number is a little bit different. It says how many I have on hand. 4 of those I were able to buy at $16.95, 10 at $18.95 for a total price of $257.30. And then we have some large beach totes that all 10 of them cost us $19.50 a piece. So overall, our total for all of those beach totes, small, medium, and large, were $2,941.25. So that is what the inventory record will look like. Okay. So our stock record, so it says some businesses keep inventory records that show continuous the quantity on hand. So we have a stock record and a stock ledger. So this is what that stock record looks like. So here's our beach tote small, and these are just the smalls, okay? Not the mediums, not the larges, just the small. We have a stock record just for the smalls. So it showed on October 10th. It tells us when we need to reorder. So if we hit 20 or less, we need to reorder. Our minimum is, so we reorder 20 at a time, and our minimum is 10. So if we get below 10 in our quantity over here, we have to order 20. Does that make sense? If we get below 10 in our balance, that's our minimum, we have to order 20. Now that number will change for different products, okay? And then of course this says where the location is in the store. So we started with on October 9th, we sold, notice it says decrease here, 2, which left us with 9, and we're under our minimum of 10. So you see the next line, and notice they're not on the same line, okay? We are going to space them out. On November 2nd, we ordered, this is our purchase order number, 410, we ordered 20 more. So now we have 29. On the 12th, we sold, notice our sales invoice number, 2. We have 27. 29th, here's our new sales invoice number. For this sale, we sold 4. We have 23. And then on the 26th, we sold 1. So we have 22 left. So it keeps track of our balance as we buy and sell. That's our stock record. So some of those things that help with that perpetual inventory, those point of sale terminals, the checkout scanners. The UPC codes are on the back. I wish, like this. This, if you can see this number right here, down here, is a UPC code. You scan that when you go through the checkout. Okay, that number is individual to every single item. And then, of course, we have a stock ledger, which is what we're going to talk about next. So we have, like I said, a couple of different methods that we're going to use to keep track of our inventory. And we might not know the best method. The thing is that when we do pick a method, we have to stay with that method. Because by law, or like, well, I would say by law, but for our reporting process to the government and to the IRS and to the Securities and Exchange Commission, we have to make sure that we're not switching back and forth between inventory methods. We pick one and we have to stay with it. And if we do end up deciding to change, then we have to note that in our information we submit to the Securities and Exchange Commission and how it affected the value of the business. So the first method is the first in, first out inventory costing method. So like I said, that is the same. If you think about the milk, you want that milk that comes in first to go out first because the dates, as it gets closer to the due date, I'm going to have to get rid of it, right? If I don't sell it. So here's what that looks like. So January 1st starts our inventory. We purchased 10 units at $20.80 a unit. So here's our cost. February 16th, we bought some more. This time it cost us $21.60. We bought some more in April. We bought some more in September. We bought some more in November. Notice all of the unit prices are different. Okay. So we bought a total of 50 units, but they're all different. So then we have our total cost. We have our total cost here of how much it costs for all of it. Now, our first in, first out. So this says we have 18 units left. And so all of this stuff, notice it's gone. There's nothing here because remember, it's first in, first out. So all the January stuff is sold. All the February stuff is sold. All the April stuff is sold. All we have left is that September and November. Okay, all we have left is that September and November. So we have 10 units, so we had a total of 18 units. So there's only 8 units let in November. So then we have to take 10 units of that 12. 10 of that 12 from September. And that's how we're going to figure out the cost for that first in, first out method. So last in, first out is going to be the opposite. The bottom's going to be open, and the top is going to have our numbers. That's how, and it's just a visual. So see how the bottom is open? Because this stuff was sold first, so it's gone. And then this stuff is what we still have. So here's still our 18, right? Here's still the same cost, same everything. But notice the different amount. So we have all 10 of those left. We have all 6 of those left. And we have 2 of those 14 left to make our 18. So notice this was 422 with the first in, first out method. With the last in, first out, it's only 382.40. So remember, our cost of inventory, the more expensive it is, the less amount of money we make. So we might consider doing this last in, first out because the cost is less, right? It depends on the products. And then, so that's the last in, first out method. And then we have our weighted average inventory. So we take all of our averages. So we've added, right? We've done all of our costs across. We have our number of units and we have our total cost. So we're going to get the average from here. So we bought 5 things. So here's how they figured that out. So we take the 1120, divide it by the number of units, and that gives us an average of 2240 per unit, right? That unit price. The average is 2240. So then we have, let me move this so you can, I don't know if you can see that. So then we have 18 units, right? That's how much we had left. We multiply it by that average, and then our cost of inventory for the weighted average is 40320. So all three gave us different numbers. Okay. All three gave us different numbers. So our first in, first out was like 422. Our LIFO, our last in, first out was like 380. And then this average is 403. So they're all giving us different. So this is the formula we're going to use for that weighted average. All right. So, oh, so to calculate our cost of merchandise sold, we're going to take that 1120, that's our merchandise, what we call available for sale. We're going to subtract out the cost, and so that's how we figure out our cost of merchandise sold. So this is how much our merchandise costs us that we sold. Okay. So part of it, we're going to do a comparison. So they're each going to be next to each other. We're going to figure out how much our cost of merchandise sold is. And then we're going to say, okay, is the cost high, low, or intermediate compared to our inventory? So notice the numbers are the same. Here's our ending inventory. So this is how much our cost is based on that. So which one is the highest? So it says period in rising prices, relative cost to the ending inventory. Which one is our lowest? So here's our ending inventory, right? Here's our ending inventory. And which one is intermediate? So this one is the highest because it's 422. This one is the lowest because it's 382. And this one is intermediate because it's between. Okay. And then it says relative cost to the cost of merchandise sold. So this number. So this is going to be the highest. This is going to be that intermediate. And this is going to be my lowest. Okay. So that's how we figure out. So this top is based on our inventory number. The bottom is based on our cost of merchandise sold number. So there's also so we look at, then we decide, okay, there's something called the lower of cost or market. So we're going to look at the 3 options and then we decide which one we're going to use. So if the market price is $22.50, we look at our cost here for our for our FIFO. If we look at our market price for those 18 units, the lower cost of market was 405. It was only 405. So we picked the lowest one between the two. Okay. This one, it's 405, but our LIFO was less than that. So we're going to pick the LIFO one. And the last one, we're still at 405 for our market. The weighted average was slightly less, and that's what's going to be our loan. So basically, we're just picking the number that's the lowest out of the comparison between the two numbers. That's how we figure out lower cost of market. That's literally all it is. We're looking for the lowest number. So inventory. So gross profit method for estimating inventory. So what we're going to do, and they actually have this set up in your working papers. They actually have it broken down. So we look at how much inventory we had in January, how much we bought, and so then we have how much we have available for sale. Then we look at our net sales for that same period, and we're going to times it by last year's gross profit percentage. So last year, 40%, we made 40% profit on our inventory. So we're going to use that 40%. So that gives us, so this is how much our gross profit should be, right? If it's similar to last year. So we should make about 48,000 off of that, off out of our net sales. So about 48,000 out of that 122,000 should be profit. And then we're going to take those same net sales and we're going to subtract out that gross profit. And this is how much that merchandise should have cost us, right? Cost of merchandise sold should have cost us. That's 73. So that's how we figure out. So literally, we're just following the steps and we're using the numbers that they provide. The only number that we're really going to, I mean, obviously, we're going to have to do a little bit of addition and subtraction, a little bit of multiplication, but all of the beginning numbers they give us, okay, and the net purchases and stuff like that, they give us all of this information and we just plug the numbers in and do the calculations. And then of course the last part is our cost of merchandise available for sale. That's that step one. And then we have our less our step three, this cost of merchandise sold. So then this tells us how much we should have in our ending inventory. So it says when the gross profit method of estimating inventory is used for months other than the first month of fiscal period, the process is the same as we've just done. So basically, it doesn't matter if it's a full year or just a month, we're going to do it the same way. All right. So now we're going to do this stuff together and we're going to show, and I'm going to record it even though we're going to do it together, and we'll put it up there for you guys in MindTap. So have a great weekend, and I will see you next week.